I'll tell you one thing for sure. I've never seen the amount of incoming concern over the banks as I'm seeing right now. The next shoe to fall is credit. They think that the worst is past. By the way, I don't even think we're into the second inning yet.
I want to start our discussion somewhere a little bit different. Most people would be expecting, okay, the banking system's melting down. Luke and Foss probably going to be talking about credit default swaps and things like that. But I want to actually start our conversation in a different direction. I'm going to share my screen, show you a graph of the Bitcoin hash rate because it has been going absolutely parabolic. Foss, what's your thoughts on the parabolic Bitcoin hash rate?
Not being an expert in the area, I have a few. Well, let's put it this way: there are a few possible scenarios that a hash rate is increasing, including the one where Peter McCormick just mentioned it. Our nation states mining Bitcoin, and a probabilities guy in me would say 100%. There is a nation state somewhere, but it may not be a big one. And we probably know that El Salvador is doing it on a fairly small scale. But let's focus on what the possibilities are. And when you're at 400 exahash a second, and the price of Bitcoin, has performed, but it certainly hasn't gone parabolic like the hash rate, you start to ask yourself these questions, which would make it a possibility or a probability analysis. And I don't think it's greater. And when I say a nation state, I mean, let's talk the real nation states that are not the friends of the United States, who are in the news about talking about the demise of the American dollar. So you either think China or you think Russia. And I would say the probability is somewhere greater than 20% that they are, but less than, I don't know, I'll just throw another number, less than 40%. So somewhere in that range. Why would they do it? Well, firstly, because it would be strategically smart from a financial perspective. And then secondly, if you have an abundance of energy that essentially you can argue, now the truth is it's not, but you can argue that the energy costs are almost free. And when you have almost free energy costs, whether it's in the case of an electric utility that otherwise would have to, pay another nation. I'm using Canada in that case, because Canada does actually have to pay the United States, not sell power cheaply, but actually has to pay the United States to take our power at times. You could argue, well, it would certainly make sense to mine Bitcoin with that wasted energy. You could look at flare gas. You could look at things like, well, we've developed all this infrastructure in oil and gas, and there are ways to make it appear like it's a zero cost. Luke, I would suggest that all of these cases make it somewhat attractive to consider that. So you put a probability on that, but then you bring just within the last 12 months, I had my reserve asset. Speaking of Russia here, I had my US Treasury bonds frozen. Well, I mean, don't tell me that that's not a concern if you're trying to manage your risk profile, that your reserves were frozen. So the betting man in me would say, yes, it's a greater than 0% chance. How much money would I put on it? If you gave me 5-to-1 odds, I would probably take that bet, meaning I'll bet $1 that they are, and you pay me $5 if we prove that they are. And that's the bet I would make. You know what I mean?
Yeah, everything's a probability.
Yeah.
And obviously, I think our first discussion was in October 2021. I went back and I checked the tapes. And then I think you said, look, it would be absolutely ridiculous if Putin wasn't at least considering his probabilities of mining Bitcoin. And of course, we know what happened in 2022. Putin's come out and said, look, I'd accept your Bitcoin for my natural gas. It's really interesting how things have developed.
Things are happening fast. It's one of my taglines. Risk happens fast. The world is changing quicker than it ever has.
Yeah, it definitely is. Another one of your taglines, or another one of the things you're a little bit more famous for talking about, I suppose, would be credit default swaps. And I shoot you over a little tweet this morning, and it looks as if CNBC has actually delisted the credit default swaps for some of the biggest banks in America. So I think it was Bank of America, I think it was JP Morgan, there was a couple of other in there. Well, what do you read into that, Foss?
Well, luckily I never took my news or my credit default swap feeds from CNBC, so it wouldn't have impacted me. I would always get them off of Bloomberg and what's called runs from the dealer community. So Goldman Sachs would send out their runs on CDS on various things. But that's a compilation of different sources of information to put out that feed. And I have to be very honest. I think that firstly, let me say this. I'm extremely proud that the world actually even knows what a credit default swap is now, okay? Because not because of me, but I just, having spent my life in credit, this is something that I only learned, because they've only existed since, I'm going to guess they've only existed since about 2005, probably even, no, maybe the year 2002. And they were developed by Blythe Mathers, very smart lady at JP Morgan, back in, around the early 2000s. And they were a method of trading risk amongst with a credit view where you didn't actually have to borrow the bond. Let's say you wanted to short a credit, Luke. When you short a credit, you actually have to borrow the bond. Whereas a CDS, you just say, hey, you're my counterparty. I'm going to bet on the default probability of the reference asset, whether it's XYZ company or XYZ state or XYZ country. But you don't actually have to borrow anything. It provides a much more frictionless ability to take a wager and perhaps hedge credit default exposure. So this CDS market is absolutely played by the big boys. You sent around a tweet where some equity knucklehead says something like, "Oh, it's not liquid." Like, here's the problem: everyone listens to these equity guys on credit. They don't know shit about fuck. Okay, these guys are so damn misinformed, and they make a statement like, "Oh, CDS isn't liquid." If you actually understood the volumes that trade on CDS versus the appearance of liquidity of volume trading on a stock, but then you do the market cap of the debt, the value of the debt that's traded versus the market cap of the stock that's actually traded. In most cases, it's not even close, but you have these equity guys opining on stuff they have no idea what they're doing. But credit runs the world. So firstly, I'm very happy everyone's starting to learn, because my thesis is Bitcoin's actually a credit default swap on a basket of fiat currencies, which means you own insurance on the demise of that basket or components of that basket. And it's a beautiful instrument because Bitcoin doesn't have any counterparty risk. It's like just this infinite or perpetual insurance contract with no counterparty risk. So I love the name CDS. I've spent my life in the credit markets. I believe it's pure signal. And the reality is, why did CNBC potentially, why did they stop? Well, because all these equity guys are finally realizing that CDS leads to stock price correlation, meaning when the spread widens, the stock price goes down. They don't want people knowing that, oh my goodness, the CDS or the credit default swap, CDS credit default swap spread, so the premium, it's widening on Bank of America, which means the stock price maybe should be going down. And they don't want to allow people to have that information because they want to have that bid in the market so people can stuff that bid, the irresponsible or uneducated bid. And that's largely what equity guys are, okay? There's so many fools in equities. It's just not funny how stupid the money that is participating in the equity square usually is. Led by the fool cheerleader of them all, Jim Cramer, right? On CNBC, saying shit like, this bank is a fortress. He doesn't have the first clue about how to analyze the true risk in the balance sheet of a bank. And he goes on, oh, well, we need to support this bank. So I'm going to make a statement like I actually know something. So maybe, Luke, maybe they took off that feed just because of that. Is there a conspiracy theorist in me that could believe it? Oh, yeah. Does it make my life any different? No. I promise you, when you have a Bloomberg machine, you pay to get this information because this is the information that makes the world work, you know?
Yeah, exactly right. You bring up a really interesting point there about Jim Cramer, and I'm actually going to share my screen again because I was going to show you a clip from a video that I wanted your opinion from. And
real problem with Credit Suisse, which is the analog, is they never made any money. Deutsche Bank is actually very profitable. So let's start there. Why bail out a bank that is just a chronic loser versus a bank that's doing well?
Credit Suisse looks very shaky, which is something you've been tweeting about a lot. So maybe this is a good point to get into our discussion about macro. What's your thoughts about Credit Suisse? And then maybe we can get into Deutsche Bank.
Yeah, let's start with Credit Suisse. So firstly, Credit Suisse was rescued, okay? And by the way, it was rescued using some nefarious instruments or basically disadvantaging some instruments called AT1 bonds or alternative tier 1 bonds, otherwise known as COCOs, which are contingent convertible bonds that qualify as alternative tier 1 capital, which means tier 1 capital in the BIS banking system is predominantly equity, okay? Why? Well, because equity is really the only thing that truly absorbs risk on a bank. You can't absorb risk using subordinate debt because subordinate debt adds to the risk, meaning, you know, if you have tier 2 capital, which is subordinate debt, don't tell me that that's a form of risk absorbing. No, those bonds themselves are a liability, whereas equities, okay, they are the pure risk absorbing component of the capital structure. So the guys needed to raise more capital for the banking system because everybody knows the banks are undercapitalized. So they dreamt up this gimmick called AT1 or alternative tier 1 bonds. And in the case of Credit Suisse, there was 17 billion face value of these bonds that got written off at zero while they still rescued $3 billion worth of the common stock. Okay. Now, at least they should have been treated pari passu. There's no way you can convince me that the bond should have been treated as a disadvantage to the equity. Maybe you treat them equally, but normally bonds have a prior claim on restructuring. And in this case, in this Credit Suisse restructuring, they didn't. They got a zero. 17 billion of it written down to zero, whereas the equity still had a $3 billion market value in order to get the merger with UBS done. Okay, why did the equity still have market cap or market value? Probably because most of the bonuses at CSFB or Credit Suisse were going to be paid out in equity, and they didn't want it to be worth zero. Secondly, just because they had to get something done at over a weekend, which is typical, right? And they were able to zero out the bonds. And these bonds, they cost a lot of people money, including PIMCO, Pacific Investment Management Company based in LA. Lost $800 million of face value on these bonds. And who are the people that bear the brunt of that? Well, the pensioners that have their money in PIMCO. So let's make sure we understand what really happened here. It was a gimmick accounting or a gimmick instrument that got zeroed out and rewrote the rules of finance and gets glossed over by the regulators as, oh, well, they were designed to do that. That's bullshit. It wasn't designed to do that, okay? Now, who's the biggest issuer of AT1 bonds in the world? Deutsche Bank. Oh, well, you better start worrying then if you've provided capital to Deutsche Bank, which, by the way, they might be profitable, but they are not well capitalized. So let's go back to idiot Jim Cramer, what he said. Yes, they can be profitable. It doesn't mean they're well capitalized. Just because you can run a profitable business in air quotes doesn't mean you're properly marking to market all the assets on your balance sheet, particularly when you have something like $60 trillion of derivatives. Now, just give me a full stop. Cramer has no clue how to actually mark to market those derivatives. He has no clue how to properly mark to market the exposure on Deutsche Bank's balance sheet, but he comes out and says some stupid statement about profitability. Banks don't actually, they manage their profitability, Luke. It's all about how much loan loss reserves they have to write down each quarter. And that's managing their profitability. So Kramer once again shows his absolute misunderstanding of how banks work. I wouldn't listen to that man about very much when it comes to credit because he's never spent any time in the credit markets. He's just a voice box for equity. And now remember, just for your listeners, equity ranks subordinate to bonds in a capital structure. Okay. If you don't know, if you're an equity investor and you don't know what the debt investors are saying about the company in terms of its credit quality and its its sustainability, you're investing blind. You really shouldn't be investing on behalf of clients because you don't know what you're doing. And I always say, always watch the equity, always watch the credit. And what can credit guys do? Well, since these guys have a prior claim, they can short the shit out of this thing to protect and hedge their exposure up here. And that's frequently what happens. So when credit default spreads widen, one of the hedges is you can go into the publicly traded equity markets and short that stock as a hedge against your default risk. Happens all the time. It's correlation. It's the same capital structure. You're formulating an enterprise value based on the same cash flows. And, there was an interesting thing that happened, not just with the AT1 bonds, but then Deutsche Bank went out and repurchased some debt and it caused an open leg on, and we talked about that in that I can't call it an argument, but on that podcast that Spaces that you noticed what I said to the guy, wrong. Basically, the reality is that open leg caused a naked position where the guys had to go out and reach for default protection because by buying back the debt, the bank had exposed these credit default swap sellers to an open leg. And we could get into the technicalities. We don't have to. The point is, this is a very complex capital structure arbitrage thing that most people don't understand. And sometimes there's unintended consequences, including when the bank thinks they're doing a good thing by buying back the debt. They actually are making people reach for default protection to cover they had sold protection. Now they have to buy it back. Okay. And it gaps wider. And then everyone's like, oh my gosh, what's going on with Deutsche Bank? So very, very smart players, but hedged and wedged, lots of different moving parts.
Now, I wanted to quickly interrupt today's chat with Greg Foss to let you know about our amazing show sponsors. If you are in the market looking to purchase a little bit more insurance on the fiat legacy financial system, I would love to point you towards Swan Bitcoin. They're a great Bitcoin-only educational company, and they will also help you buy Bitcoin easily, and they're going to give you $10 of free Bitcoin if you sign up using the link in the description of today's video. We're thrilled to be partnering up with Swan Bitcoin. They're a great company, so definitely check them out. And once you've bought your Bitcoin, if you're looking for somewhere to put that Bitcoin in a safe place, we recommend you check out the Foundation Passport hardware wallet. It's one of the best hardware wallets there is in the space. It's a high-end product, visually very appealing, and it has great QR code functionality, which makes sending and receiving Bitcoin an absolute walk in the park. So if you want $10 of that puppy, you can use promo code BEAST. And last but not least, let's hear from our final show sponsor today. That is, of course, the Bitcoin Miami 2023 conference. You guys can get 10% off your tickets if you use promo code CoinBeast. Again, links to all the show sponsors are in the description of today's video. Let's get back into this discussion with the one and the only Greg Foss. Yeah, there is a lot going on right now, Foss, and I'd love to get into the technicals maybe a little bit later on in the pod, but maybe first, I would love to get your high-level synopsis of what's gone on in the past 3 to 4 months. Like, you probably got lots of calls from just everyday Joe and Janes who might not be following all this nerdy macroeconomic stuff like us. And how would you explain what's been going on over the past couple of months? We've seen Silicon Valley Bank go down. biggest bank run in 80 years, some people are calling it. What do you say is like the high level problem, or what's happening? What are we seeing right now?
Yeah, let's just summarize it very simply by saying over the last 40 years, every successive bank crisis has been kicked up a notch, where it's the nations that bail out the system. But they don't solve the system. The leverage in the banking system continues at irresponsibly high levels, and the socialization of the losses happens at the sovereign debt level. So it's basically these too big to fail institutions get bailed out by the country, right? So there were 4 or 5 crises. I mean, I always start with Latin American debt, then long-term capital management, then the great financial crisis, then COVID, now the bank runs of 2023. But listen, this is a slow motion car crash, okay? I've been calling for Credit Suisse to be in financial distress for about 3 years. And I happened to get lucky and call it, last summer. When I say lucky, I just noted that the CDS spreads on Credit Suisse had surpassed their GFC, or great financial crisis highs, which means the market's implying a higher level of distress than they ever have, despite all of these other events they've been through. And why is that? Well, look, in the case of CSF or Credit Suisse, they had this thing called Archegos. You guys may have remembered that, where they had a prime broker blow up and they lost like $10 billion. And then Green Hill Capital, another one. In combination, they had lost about $20 billion in various stupid risk management, which only left them with a market cap of under $10 billion. That's not a lot of protection on a bank that runs the levels of risk it did. So it was just a probability weighted scenario. But the crap hit the fan because of a global contagion event that by and large was started in the USA. But it doesn't matter. Banking is banking, Luke. All of these banks are levered 20 to 25 times to their equity capital base, which is another way of saying if their loan book loses 4% of its value, the equity's vaporized. 4% is not a big margin of error to play with. So the business of banking caught up with these knuckleheads that had made bad duration matched. They bought long-term treasury bonds. Now, everyone always thinks of the capital of a bank, and the big risk factor of a bank is credit risk, which is true, except recently it turned out to be interest rate risk, because for the last 40 years, interest rates have been going down. And when interest rates go down, bond prices go up, which means largely the banks were sitting on something called unrecognized gains. Well, as soon as interest rates turn around because the Fed starts pushing interest rates up, these gains turn into losses. And once they're losses, if they have to crystallize those losses because of a run on the bank, well, that's when things get ugly. So CSFB, I call it CSFB, stands for Credit Suisse First Boston, but they paired off the First Boston side. Credit Suisse got caught up in this contagion event, but look, it was bound to happen because they were over levered, undercapitalized to begin with. And we saw the results. So what is another one to fall? Look, Jim Cramer, I'm sorry, sir, but Deutsche Bank is just as poorly capitalized on a relative basis as Credit Suisse was.
Yeah, I think that's a great point. You raised lots of good ones there, Foss, but I remember I was going to bring up this tweet in our discussion at some stage. You were talking about credit default swaps, and you say, everyone in the world right now is a credit default swap junkie. I'm proud of every single one of you. Credit default swaps run the world. Cramer runs the Eurodals. So, yeah. Foss, what did you mean by that one there?
Well, again, it's all credit, and then Cramer should be handing out towels in the public restroom, right? Because he's just a total fucking buffoon. I have to say it. He's just a mouthpiece for the fiat Ponzi. He may well know that he's, giving horrible advice, but my spider senses tell me, no, he's just a stupid, does about 2 minutes of due diligence and bases his research off of nothing more than, I shop at Bed Bath & Beyond. It's got to be a good store without even doing the analysis, right?
No, I couldn't agree more. Obviously, I did a video a little while ago on Silicon Valley Bank, and I found receipts of him shilling that bank as well, just before its bankruptcy. Here's the perfect counter indicator.
Most of the time, but the bigger problem is, I mean, like, we can joke about that, Luke, but the reality is people lose real money, right? And people lose savings, and that's the biggest problem I have with it. I have no problem if he firmly believes in a position and he's done the research on it. Okay, that's fine. But for him, most of the time, it's nothing more, again, than 2 minutes of due diligence and no math to back it up. Just, oh, my friends all say, that Deutsche Bank is fine, or it's just very disappointing from a risk manager perspective.
Exactly. You've got to have the receipts. That's something Mark Moss taught me in the years that I was working for him. Always bring the receipts. And that gets me into something else I want to bring up, Foss. On a recent podcast, I don't remember which one, you said that you think the commercial real estate, mortgage-backed securities could be in a lot of stress and maybe even more stress than the mortgage-backed security market of 08. So I want to bring up a chart here that you shared a link to on your Twitter. You shared a link to this Wall Street Journal article, and it's got this really great chart looking at the amount of losses.
Yeah. It's mind-boggling. This is a must-read chart included in there. Excuse me, a must-read article. There's 12 different charts, but one of the charts that struck me was certainly this the commercial real estate exposure and the losses on commercial real estate.
Yeah. So what's your thoughts on commercial real estate right now? Are they?
Yeah, well, let's just look at it from a, 5,000-foot view. I mean, COVID caused a lot of people not to have to go to the office. They've realized that they don't want to go to the office. If you can work from home, it's more fun than going to the office, which means there's a lot of office space. I think on one of the charts, it shows a 20% vacancy rate. Okay. 20% vacancy rate, which means you don't need as much office space as you used to. Not to mention there's new supply that's come onto the market. And most importantly, and here's something that flies under most people's radars, the valuation metrics of commercial real estate have to go down because interest rates in general have gone up. So there's a thing called the cap rate, which is used to value the cash flows of a commercial real estate project. When that cap rate increases, the value of that project goes down, which is also another way of saying the loan to value ratio has probably gone higher, which means if you lent originally at 70% loan to value, now you're probably sitting at 100% loan to value. Well, guess who owns the property at 100% loan to value? The bank. The guy that developed the property, he's like, okay, here are the keys. Thanks for lending me money, you stupid turnips. And now I'm passing the keys over to you. Now you need to manage the risk. And so those are, it's a bit of the perfect storm. And by the way, where does all commercial real estate exposure live in the United States anyway? On the regional and super regional banks balance sheets, which is just another, going to add fuel to the fire of their undercapitalization.
Yeah, that's a great point. I think keeping your eyes peeled on commercial real estate is a big one. Like you say, the change in trends of where people are working these days, it's enormous. There's so many people not going back to the office.
Yeah.
So I think that's a great one to point out. I think we've just about covered everything in the macro space. I wanted to hit with you, Foss. Let's maybe transition a little bit more into the Bitcoin space. So something else that you're famous for, something that you always beat the drum about, is Bitcoin should be traded as a risk-off asset. Bloomberg last year came out with an article saying, hey, look, there's a chance Bitcoin could be traded as a risk-off asset by the end of 2022. And now I might throw up a chart for the listeners later, but Bitcoin's up like 75% for 2023. Meanwhile, equities are up like 2, 3, 4%. They're hardly moving. Is this the beginning of Bitcoin becoming a risk-off trade, or is it a little bit further down the line?
Unable to comment for sure, but I can just tell you, since I've been involved in Bitcoin, I've always considered it my insurance policy. So therefore it is risk off for me. Like, insurance is your risk off backstop, right? And more importantly, when you can see a forest fire coming, you don't sell your fire insurance on your house because it's gotten more valuable. There's a reason. So that's another reason that you always hold insurance. You don't trade your insurance so much. Is this the thing that tipped the in favor of the risk on versus risk off? Potentially, but don't forget, this is what Bitcoin was designed for. Bitcoin was designed in the great financial crisis of 2008, 2009 to be an alternative to the banking system. Well, right now, the banking system is not doing well, and it's not surprising that people are making, blazing a trail to get some exposure to Bitcoin. So it's doing what I think it should do in a time when not just you can see the beauty of Bitcoin, you can see the failures and the fiat Ponzi nature of the banking system. Because the banks are basically the transfer mechanism for the fiat Ponzi. They're the things that are all levered. And when you lose confidence in that transfer mechanism, you need to find an alternative, which is Bitcoin. So I hope that you can appreciate that there's at least some people on the margin that are doing that trade. Does it mean forever it'll be traded? It's a process, Luke. I think education and everything is paramount. I'll tell you one thing for sure. From my direct messages, and I've never seen the amount of incoming concern over the banks as I'm seeing right now. And this is including during the great financial crisis, okay? Now people are far more aware of the potential because they remember what happened the last time. So incoming concern, Twitter, even on CNBC, the fact that they stopped publishing credit default swaps on the financial institutions, let's just think about that for a sec. So I think the anecdotal evidence is pretty clear. Does it mean it won't flip back? No, come on. It's finally growing into an asset where, people can take a view and everything, and it's getting big. It's over $500 billion. That's finally the size of an asset class where the big boys can really start sinking their teeth into it. I think that Bitcoin will be a $10 trillion asset before long. And at $10 trillion, you can do the math. That's sort of like somewhere around 500,000 US dollars per Bitcoin. Come back and we'll talk then, and we'll really see how the market's treating it as a risk on or risk off asset.
Couldn't agree more. It'll be the elephant in the room if it gets to be a $10 trillion asset.
Yeah, but it'll still pale. Let's just make sure that we understand the total global financial assets, $900 trillion. So even if Bitcoin got to 10, that's still 1/90th, only 1/90th, just over 1% of all financial assets in the world. It's still pretty small, even though it sounds big, right?
Still a lot of gains out there, even at a $10 trillion market cap, Foss. I couldn't agree more. There's one more question about Bitcoin I wanted to ask you.
All right. Well, I have one for you.
Yeah, hit me.
I want to make sure, because we were talking about that Wall Street Journal article, and I'm actually amazed that article didn't cause more consternation today on the open in bank stocks. I did tweet out one thought today that 10 years ago or 15 years ago, that would have caused bank stocks to be down another 10 to 15%, just my estimation. So, I mean, either people are not subscribing to the Wall Street Journal as much as they used to, or they think that the worst is past. By the way, I don't even think we're into the second inning yet. So just be real careful out there. Manage risk appropriately, people. The next shoe to fall is credit. This has all been driven by interest rate risk, and now we're going to get the credit concerns that will hit the banks in a position that they're already reeling from losses on the interest rate mismanagement, right? So just be careful. I suggest people stay close to home on their position sizes and true risk profile, and then just keep stacking sats, because over time, we know that dollar cost averaging is the best way to get your exposure to Bitcoin. And I do believe that it is working as intended. It is insurance on the fiat Ponzi.
That's a great point you bring up about dollar cost averaging there. Our good friend, the young whiz kid, Dylan Leclerc, put out a pretty interesting tweet the other day. He showed that if you were dollar cost averaging from the 2021...
69, 69,000.
Yeah, he showed that if you've been dollar cost averaging from the very top of Bitcoin all the way down, you would actually be in profit today, despite the price of Bitcoin
Right
still being
around break
down.
even. Yeah, right around break
Yeah.
even. And it's beautiful. And that just shows the power of dollar cost averaging. I agree.
Yeah, even on the worst possible time
No,
frame
I
for
get it.
Bitcoin.
Yeah. It's
It's beautiful.
perfect. Yeah,
No, it's
it is
really good.
beautiful. Yeah. Yeah,
Now,
Dylan does some great work. I like the young kids in the square, including you, obviously. But
oh, I'm not
yeah.
that young.
Well, you're not that old either. I'm still twice your age. Let's make sure that that we put things relative. So
Hey, I probably feel older than you right now. The missus is calling me an old man because I have sciatic pain, so
ooh,
I'm
all
hobbling
right.
around the house like a
All
little bit of a
right.
cripple,
Well,
but I'm
all
feeling
right.
it.
Yeah, go and make amends. Get some proper stretching exercises or something, or muscle. I think you have to do some muscle exercises for your sciatica, right?
Yeah, I need to put on some more beef. I'm a little bit skinny. Boss, speaking of the gym, I want to transition the conversation into weather a little bit. And I have a couple of final rapid fire questions for you. Would you prefer to be on the ski slopes in Canada, or would you prefer to be living on the beach in
Oh
El Salvador?
wow. Damn, I love both of them. I'm a skier and a surfer. I'm not as good a surfer. Oh, let's be careful. I like stand-up paddleboarding now because I'm too fat to get up off of a surfboard. So I'm an okay stand-up paddleboarder. But compared to skiing, I mean, it's much easier to ski in Canada than it is surf. So I enjoy both sports, and I guess I would just say I'd love to live in California because you can basically do both. A little more difficult to do it skiing in El Salvador or surfing in Canada. That being said, yeah, got to make time for both of them. Both great sports.
Yeah, I agree. A lot of people always ask me because I have that bogan looking Australian haircuts. Everybody assumes I'm a surfer. And they always ask me, first question, do you surf? You from Australia? I'm like, I prefer to just stand up on the paddleboard. I'm like you,
Oh,
boss. So
good.
surfing's a
Yeah.
bit difficult.
Well, no, but stand-up paddle surfing is amazing. Like, because
Mm.
you get it in a standing start, and then you can peel down the wave. It's really fun.
No, it is. It's great fun. Another little question I got for you. You do a lot of travels. I've seen you all over America. I missed you in El Salvador recently at that conference you were speaking at. What's your favorite country outside of Canada to travel to?
Well, my favorite country still is United States, only
Mm,
because I have to be honest. Look, if the USA goes down, the world is absolutely
mm,
screwed. So I need the USA to get their act in gear. Uh, I happen to own a couple of properties in the USA. They are on beaches, both on the East Coast, but it's been a very near and dear to my heart for many, many years in the USA. But I did just come back from El Salvador. I'd never been there before, although I'd been to Costa Rica 4 times, and I see the countries very similarly geographically. But then an unbelievable country I went to, or a region, Madeira, with
mm.
a bunch of Bitcoiners. You talk about a beautiful. It's Hawaii in the Atlantic Ocean. It's similar. It's a volcanic island, and just absolutely gorgeous with great surfing, great people, great food, great weather, and it's only 2 hours off the coast of Portugal. So you're sort of close to some pretty cool parts of the world, even though Europe is basically a dumpster fire, right? Like, I mean, in terms of them managing their social,
And economic policies. Yeah, Europe's
yeah,
a
it's a little that well, anyway, it's unfortunate they haven't done their mathematics. So but okay, so Madeira, El Salvador, but let's just go to some old places. Like I went to Edinburgh this year with Jeff Booth. I went to Bulgaria. We traveled around Bulgaria. My God, what a beautiful country, all right. Just the history in Bulgaria, you have no idea how cool it is. And a lot of really, really cool Bitcoiners there. I got to get to Australia. We've had a number of invites to get there. That's pretty far
mm.
on the other side of the world, but man, it sounds like a great country. So that'll be on the to-do list. But yeah, just enjoying meeting Bitcoiners all across the world. Generally, well, not just generally, like I can say with a high degree of confidence that there's some of the best people in the world I've ever met.
I couldn't agree more, brother. The Bitcoin community is a really fun community to just be interacting with. Which of those countries do you think you found the most vibrant Bitcoin scene in terms of maybe adoption or just Bitcoin has been there?
Oh, it has it like hands down El Salvador.
Mm.
Like, I mean, it's just unbelievable, like you can Bitcoin Beach and Roman Martinez and the guys at Bitcoin Beach and what they're doing there is just off the charts. But then you also have the endorsement of a quite a eclectic leader, right? Like Bukele is like he's the balls, man. Like he really is. He doesn't he fights hard. He'd be an amazing hockey player. All right, like you'd want him on your team as a hockey player. There's no question. So, but then you see relative levels of that in different places. But let's go back to the people. The people are what make it. So then, if you have these people everywhere in the world, that they're going to come around. Like the countries are going to come around.
Exactly. Bukele's really very popular everywhere in Latin America. I was at a local 7-Eleven equivalent here in Colombia, and I saw a big picture of Nayib
No
Bukele.
way. No
He
way.
was
Wow.
smiling on the front cover of one of their local magazines. And I asked the missus, can you translate that for me? I'm a little bit of a gringo. I don't speak that much Spanish. And she said, yeah, they're saying really nice things about him.
Oh,
So
nice.
that's very interesting.
Yeah.
Foss, we've been going for about an hour, my friend. I want to be respectful of your time. You're doing all sorts of podcast appearances. I know you've got another one later this afternoon. You're speaking at all sorts of different conferences. Is there anything else you're doing in the Bitcoin space at the moment?
Yeah, I'm proud to be part of including with Mark Moss, your old business partner. We are launching a Bitcoin Opportunities Fund. So to support the Bitcoin ecosystem with new investment or trade existing investments that might have been knocked down in value. So let's say some distressed Bitcoin mining opportunities, or here's the one that I get so excited about, or just short the TradFi space. Like, look, I've been short Western Union, and I will be short Western Union for the end of time. That's a trade that, if you want to express that type of viewpoint, you can do it in this fund. But this fund is okay. So there's the two most important people, James Lavish, have you had James on your show? Okay, you met James when we were down in San Clemente with Mark. So this is where we had the genesis of that idea, was when you were out at lunch with myself and Mark and James. So James Lavish, portfolio manager, David Foley, portfolio manager. James is based in Las Vegas, David in Boston. And David Foley is currently a business partner with Larry Lepard, who's just another great Bitcoiner, 30-year plus veteran of the financial markets. So you have the two portfolio managers, and then we have 4 advisors, of which I'm one. Mark Moss is another advisor, Larry Lepard, and then Corey Clipston from Swan Bitcoin. So you can think of those as the group of 6 fairly experienced guys from a financial risk management perspective that want to do what we can to attract new capital, bring a new dynamic. It's not, we're not aiming to outperform Bitcoin as much as provide a similar type of return with lower risk, because we can take short positions, we can trade volatility, we can do volatility management or option strategies on Bitcoin itself and extract vol from the market that otherwise people would have difficulty doing or managing. The ability to short traditional finance legacy stocks. I mean, I can promise you we would have been short Credit Suisse. I can promise you there's other good short opportunities out there right now. So excuse me, that's what the future holds for us. I'm bullish on the Bitcoin ecosystem, and the reality is the ecosystem has been pulled down a little bit because of things like FTX, because of things like Terra Luna, because of things like, shitcoiners, regulation, all the stuff that, is the ebb and flow that causes asset prices to change. We'd like to think we're in a position to manage that risk and take advantage of some of the opportunities that the markets are providing with us.
I love it. Yeah, I'm really interested to see where that goes. Obviously, you're doing so much for the space. I was going to show one of your tweets from 2022 calling out Credit Suisse and their credit default swaps. You've been singing that alarm for many years. So, Foss, where would you like to send the listeners? If they've got any hate mail, where do they send that, and where do they come hear more about you?
Well, as always, send your hate mail to Luke, please. But no, I'll try and respond to hate mail myself. I'm not saying I have all the answers. I like to say that all I bring to the table is 35 years of mistakes, but at least I've survived those mistakes, and you roll with the punches, and you're not a knucklehead like Peter Schiff that's been wrong for the last 14 years on the greatest asset that's ever been invented, and he still sticks to his, outdated philosophy and thesis. So I'm in the Bitcoin community on Twitter, Foss, Greg Foss, so Foss, Greg Foss. I mean, I'm on LinkedIn. If you have more questions about the Bitcoin Opportunities Fund, I'm sure we could field those questions. But more than anything, I like getting out and meeting the younger kids in this community. I will be at Bitcoin Miami. I'm going to be at Thank God for Bitcoin right before that. I know I'm going to Unconfiscatable, which is a tone-based conference in Las Vegas towards the end of right around Christmas. I know there's one or two more. Oh yeah, there's a Canadian Bitcoin conference, which I'm excited about. So yeah, you know what? I mean, I really enjoy meeting everybody in the space. Some really, really good Bitcoiners. And I learn a lot too, right? Like, cause I joke, I'm 60 years old, but I'm really not that good at managing an iPhone, or technology. So, you got to understand that there's, just because you have a lot of experience doesn't mean you're an expert in a new technology, which is a good stepping off point. Don't listen to Charlie Munger when it comes to Bitcoin. He doesn't understand technology. In fact, they tell people they don't understand technology. So just do your own research. Understand that the only wrong allocation to Bitcoin is owning zero. Figure out how much you need, dollar cost average yourself to get yourself that exposure for the good of your kids and your kids' kids, right? Future generations.
I think that's a brilliant note to end it on. Get off zero, and it's for the kids. Greg,
All right,
thank you
brother.
for your time. There you have it. That is my discussion with the one and the only Greg Foss. Okay, what do you guys think? Do you think the 2023 banking crisis could actually turn out to be worse than the 2008 GFC? Are we in the first innings of a coming wave of central bank bankruptcies that's going to emerge all around the world? I don't know. Let me know your thoughts in the comments down below. And if you enjoyed this one, feel free to slap a like on it and make sure you subscribe to our channel so you're notified for our upcoming interviews. And if you are enjoying this content over here on YouTube, make sure you give our amazing Bitcoin only show sponsors a little bit of love. Their help helps us improve the quality of content that we're pushing out over here on YouTube. So with all that said, guys, I hope you enjoyed that discussion with Greg. If you made it this far into this one, I'll slap another 2 videos up on screen that I think you might enjoy. And with all that said, I'll see you guys in the next video.